Okay, welcome to our first webinar from California Preservation Foundation. This is a free webinar as a benefit of membership. And over the next few months, California Preservation Foundation will be conducting more free and paid webinars. I'm Corinne Garcia. I am the Director of Education at California Preservation Foundation and will be speaking on understanding the federal tax credit. If this is your first webinar, please note that I have everybody muted. During certain times, I will unmute for anyone who has a question. So let's get started with the webinar outline. I'm going to begin the conversation by giving an overview and definitions of what the Federal Historic Tax Credit is, including what is the tax credit, the two types of historic tax credit, how the credit is calculated, and the eligibility criteria. I'll stop for questions around the midpoint of the presentation, and then after questions I'll continue with the criteria of the credit and claiming and using the credit and syndicating the credit. And there'll be a final question and answer period before finishing the webinar. So, what is the federal tax credit? Originally, it began in the 1970s and was reformed to its current program in 1986. And it is a government program that offers tax credits to owners of historic and older buildings to encourage the preservation and adaptive reuse of these buildings. The program is administered by the National Park Service, who certifies and approves the project, and the Internal Revenue Service, who ensures tax compliance and regulation. And in partnership with the State Historic Preservation Office, who reviews and forwards the builder owner's application for the tax credit to the National Park Service. The historic tax credits are a dollar-for-dollar federal reduction of your federal income tax. It is a credit. It is not a deduction of income taxes. And to be eligible for the historic tax credit, you must be the owner of the building on which rehabilitation work is going to be done. So there are two types of the federal rehabilitation tax credit. Rehabilitation and tax credit and historic tax credit are the same thing. That they're used synonymously. And the 20% tax credit equals the amount of 20% spent on a certified rehabilitation of a certified historic structure. And I'll talk a bit more about what it means to be certified and the qualified rehabilitation. The 20% tax credit is for properties for commercial, industrial, agricultural, or rental purposes. But it's not available to properties that are used exclusively as the owner's private residence. The 10% historic tax credit equals 10% of the amount spent to rehabilitate a non-historic building built before 1936. The 10% credit applies to buildings that are rehabilitated for non-residential units. So rental housing, whether it's owner-occupied or not, would not qualify for the 10% tax credit. So both of the credits have certain criteria, and one of those is in order to receive the tax credits, it must be a building. It cannot be a bridge or a ship or a railroad or a dam. It needs to be a building. And the building must be depreciable, and the meaning of that is that it's held in use for trade or business or for the production of income. And the rehabilitation cost, the amount of work that goes into the building, must be substantial compared to the value of the building at the time the rehabilitation work begins. And I'll speak more on substantial rehabilitation in a minute. And again, the $1 of tax credit reduces the federal income tax owed by $1. So how do we calculate the historic tax credit? To calculate the credit, you would take the total amount of eligible rehabilitation costs and multiply it by the percent of the tax credit. So in our example, we multiply $1 million that we spent on qualified rehab cost and multiply that by 20%, and the tax credit value is $200,000. Likewise, if we were eligible for the 10% tax credit, the value of the credit would be $100,000, or the rehabilitation cost of $1 million times 10%. So the amount of tax credit, the $200,000, would reduce your tax credit owed. So if you had $800,000 in income tax owed, your tax after the rehabilitation would be $600,000. So to talk a bit more about the specific criteria of the 10% federal rehab credit, projects must be that are eligible for 10% must meet specific physical tests for the retention of external and internal walls. At least 50% of the building's external walls at the time of the rehabilitation must remain external walls at the work's conclusion, and at least 75% of the building's internal structural framework must remain in place throughout the construction conclusion. Buildings that are listed on the National Register for Historic Places are not eligible for the 10% credit. Buildings located on the register or listed in districts that have been certified as state or local districts are presumed to be historic and are therefore not eligible for the 10%. So the 10% is for buildings that are not historic that have been built prior to 1936. And because they're considered not historic, the 10% tax credit does not require a formal review from the State Historic Preservation Office or the National Park Service, as the building is designated non-historic. So a bit more about the 20% historic tax credit. The 20% is obviously worth more than the 10%, but it also comes with more criteria to qualify. And basically 4 tests need to be passed in order to qualify for the 20% historic tax credit. The rehabilitation work must be substantial in compared to the value of the building at the time that work has started. Only certain properties will qualify for the 20% tax credit. The building must be certified historic and go through an application process, and all the rehabilitation work must follow the Secretary of Interior standards for rehabilitation. And I will discuss each of these 4 tests individually. And as I mentioned previously, the rehabilitation work on a building must be substantial in order to qualify for historic tax credits. So that means that over a 24-month period, rehabilitation costs must exceed the greater of either $500,000 or the adjusted basis of a building and its structural components. And the adjusted basis is the purchase price or the actual building value minus the cost of land or the value of land plus any improvements that already have been made in rehabilitation minus any depreciation taken. So in our example, we have bought a building for $300,000 and we know we're going to do rehabilitation work and we would really like the 20% tax credit. The value of the land has been appraised at $100,000 and is subtracted from the adjusted basis because the value of the land is not included in the rehabilitation of the building. And there's been no previous rehabilitation work, and $10,000 in depreciation has been taken and subtracted from the basis. So the final result is the adjusted basis, basically the value of the building is $198,000. So we have an adjusted basis of $198,000, which is obviously greater than $5,000, and this means to be eligible for the historic tax credit, the rehabilitation cost must exceed $198,000. So the ideal eligible building for meeting the substantial rehab test is a building that is undervalued or vacant that requires an extensive amount of rehabilitation. Projects that really don't need that much work in terms of rehabilitation, most likely because of the adjusted basis, will not qualify for historic tax credits. The rehabilitation tax credit is allowed in the taxable year that the property is placed in service, meaning that you are eligible to get your tax credit in the year the building is placed in service or put back in reuse. Once the substantial rehabilitation test is met, the amount of the credit, 20% or 10% of all qualified expenditures, rehabilitation expenditures, through the end of the tax year would be included. And what is included in the qualified rehab expenditures? Basically, all the work on the historic building, as well the rehabilitation work, as well as architectural, professional, engineering fees, even your historic preservation consultants fees. That's considered a qualified rehabilitation cost. There are other soft costs, such as legal expenses, and if the owner is charging a development fee, that is available as qualified rehab expenditure. So what does not qualify as rehab expenditures, meaning what will you not be able to count as your historic tax credit value? And this does not include the acquisition cost. So unfortunately, you cannot use a historic tax credit to acquire a building. It is meant solely to rehabilitate a building. It is not qualified in new additions to the building or site improvements, parking lots, sidewalks around the building, landscaping, or other related facilities. And the rule of thumb is if you were to pick up the building and shake it, what would fall out or would not be included when you pick up the building would not be eligible. So furniture would not be included in the qualified rehab expenditures. So at this point, I am going to stop for questions, and there is actually two ways that you can ask questions. You can either what's called raise your hand, and that is where your name is. If where that little hand mark is, if you click on that, your hand will be raised, and then I will unmute you and you can ask a question. And then also another way is you can, under chat, you can type in your question. So either way, I will be able to either see or hear your question. So, and I'll give everybody a bit of time to either type in or ask questions if they have any. Okay, there is one question from Lon Dieterman, and Lon, I'm unmuting you now. What's your question?
Yeah, hi. I guess I have a couple questions. What is the document with which the standard, all these requirements are contained in for the 10% and 20% credits?
Okay, would you mind speaking a bit louder? But the question, if I heard it, is what document is basically says the criteria for the 10% and 20% tax credit?
Correct. What is the reference document? Correct.
Okay. It is both because it's governed by both the IRS and the National Park Service. There is information on both of those websites. On the IRS, the actual Tax Reform Act is the Tax Reform Act of 1986, and it is Section 47, which actually speaks about the Rehabilitation Tax Credit, and it talks about both the 10% and the 20%. And then on the national park side, because they do the reviewing of tax credit projects, information is available through their technical bulletins and their website, national or nps.gov, under tax incentives. They have information on how the tax credit works and the application process. And I'm actually, after this question and answer period, I'm going to talk more about the actual application process.
Could you repeat the IRS reference? You said there was a Tax Reform Act of
1986, and the actual section of the code is Section 47.
Excellent. Thank you so much.
Okay. Mark Perry has a question. Mark, I am unmuting you. Mark? Mark, if you could type in your question. I'm not able to hear you. And then, Lon, did you have another question?
Oh, yeah, I typed it to you, but basically I was looking for if a PDF of this presentation would be available for download after the presentation.
Yes, and actually what I thought I forgot to mention was this webinar is being recorded, so anyone who joined us late or has to leave a bit early, the webinar recording and link to this presentation will be sent to you.
Oh, excellent.
Okay. Donna Graves, I am unmuting you. There we go. Donna?
Oh, did you unmute me?
Yes. Did you have a question?
Yeah, I sent it as a typed question, but okay. I'm new to this.
Okay.
And as you went through the calculations, it seemed to me that the threshold for getting your figure of the adjusted basis and therefore qualifying was really high. And I would imagine is an impediment in so many instances. And I wonder whether there's been much discussion or activism about making the historic tax available by reducing the
basis.
The adjusted.
Yes, there has been a lot of times to lower the adjusted basis. The advocacy has been in counting more, not really as the adjusted basis, but allowing more to be qualified rehabilitation. The adjusted basis in our example was high because of the acquisition price of the property, which unfortunately, when you have a high acquisition price, it makes it harder to qualify for historic tax credits. However, a lot of times, because some of historic buildings are vacant, or no one has seemed to come up with a viable economic plan for them, a lot of historic tax credit transactions that I've worked on are actually acquired for a really low price. But unless the acquisition cost is low, then you're going to have a high adjusted basis. Does that answer your question?
Well, I guess that it seems like then that so restricts people's ability to use this tool. And I just wondered whether there was organized or advocacy to try and shift the balance so that it's more available.
There is what's called a historic tax credit coalition, which basically advocates for continuing use and expansion of the historic tax credit. They're out of Washington, D.C. And as I said before, a lot of the advocacy comes in counting as much of rehabilitation expenditures as possible. One thing to keep in mind is the historic tax credit is just for the rehabilitation cost of a building, not for the acquisition cost of a building. And it would be great if you could lower the adjusted basis. And actually, I do believe for projects that are smaller, meaning under $1 million in qualified rehab expenditures, there is an advocacy movement to lower the adjusted basis, but that's not for larger projects.
Mm-hmm.
So I am looking at and now Donna, I see your question, and Mark, your question was answered. Great. Let's see. Craig Meinwieser, I am going to unmute you, and you had a question. Craig? Okay, I'm sorry, but I'm not able to hear you, Craig. So if you could write your question, I will be able to answer that. Oh, and here I see one right now. And your question was, can you include all of the soft costs for architectural fees, including those spent on landscaping, site design, even though the hard costs of landscaping are not allowed, or must you parse the architecture fees to remove that portion spent on landscaping and site improvements? That's a great question, and In that instance, I would think it would be a percentage of the architectural fees. If it is a lower percentage, it can be incorporated in the landscaping and the site design. If the landscaping is, if you can basically prove that it's for the overall site design. Now, if the landscaping is completely separate in a very large part of the architectural fees, you would have to itemize, so the landscaping would not be included in the soft cost for the architecture fees. Okay. Let me just take a quick look. Let's see, I have one more question. Tom Fairlin?
Yes. If your income is inadequate in the year that you're eligible for the credit, can you carry it forward or backward?
Yes, you can, and I will get to that. But to answer your question, you can use it for the previous year, 1 year, and then up to 20 years going forward. But I'll talk a bit more about that in the next part of the presentation. Okay, well, moving on, and then I'm going to stop again towards the end to open it up for more questions. So another one of the tests is for the 20% tax credit is qualifying property. Certain properties will qualify for the 20% historic tax credit. And as I mentioned before, properties must be depreciable, meaning it must be used in a trade or business or held for the production of income. And that could be in use of an office, for commercial use, for industrial use, for agricultural use. It can actually be used as a community center. A lot of times people don't think of a community center or an organization being a business, but in that case, it would qualify. It can also be used for rental housing, but it may not serve exclusively as the owner's private residence. And this is a point of difference between the 10% tax credit and the 20% tax credit. The 20% allows the residential rentals as long as they're not owner-occupied, whereas the 10% tax credit is not available to buildings that have any residential purpose. Okay, and this is where we talk a bit more about the structure and the application process of the historic tax credit. A certified historic structure is a building that is listed individually on the National Register of Historic Places, or is a building that is located in a registered historic district and certified by the National Park Service as contributing to that historic significance of the district. The owners of buildings that are not yet individually listed on the National Register or are located in districts that are not yet registered as historic districts may use the Historic Preservation Certification application to request a preliminary determination of significance for National Park Service. Now, this is the point of decision between the 10% and the 20% tax credit. Basically, if it is individually listed or a contributing building in a district or is eligible for listing on the National Register or is a state or locally significant building or in a district that has been judged by the National Park Service as historic, the historic tax credit that that building would be eligible for is the 20% tax credit. If a building is not eligible for listing and not on the National Register and not a contributing building within a district, it would be eligible for the 10%. And the as I mentioned, the for buildings that aren't yet on the register or are to be determined, there's an application that you go through for the with the Park Service to determine its certified historic status. So basically, to apply for the 20% historic tax credit, there is an application process. And part one is the evaluation of significance. Owners within a historic district that do not know if their building is contributing would fill out this part one. And the process is that the owner would submit this application to the State Historic Preservation Office, and the State Historic Preservation Office would then review the application and eventually forwards it to the National Park Service with a recommendation for approval and any other comments that it has. A lot of times there may be back and forth with the State Historic Preservation Office as to how you may be able to improve your application. Once the National Park Service receives the Part 1, it then makes a decision on if it is historic or if it is not. And if it is, it becomes a certified historic structure. Now, buildings that are individually listed on the National Register or are already certified as historic in districts, these owners, they don't need to complete the Part 1 application. So once a building is evaluated as historic, a building owner that wants the historic tax credit must complete what's called a Part 2. And that's where the description of the rehabilitation work to be completed is outlined. And again, the owner submits the Part 2 to the State Historic Preservation Office, or the SHPO, and the SHPO advises the owners on their application and forwards it to the National Park Service. And then the National Park Service can either approve, deny, or a lot of times what happens is conditionally approve your Part 2. And conditionally approve means that some of the rehabilitation is in work with the standards, and then some of the work needs to be modified. And the National Park Service reviews the rehabilitation in line with the Secretary of Interior standards for rehabilitation. And there is, in the next slide, I'll talk a bit more about these standards. But basically, once the Part 2 is approved, work can then move forward as approved, and then after the work is completed, the owner would request a Part 3, which is a certificate of completed work. Now, since the Part 2 is the applying for the actual rehabilitation work, that in turn needs to be approved for to be eligible for the historic tax credit, it is extremely wise for the owner to do this application before they actually start doing work, because they may find that the work that they did will make the building ineligible for tax credits, or they may lose out on a lot of tax credits because the work was not approved. So, as I mentioned, the National Park Service follows the Secretary of Interior standards for the rehabilitation of historic properties. And the standards are applied taking into consideration the economic and technical feasibilities of the project. And I'm sure many of you are familiar with the Secretary of Interior standards, but basically there are 10 rehabilitation standards that are intended to retain the important architectural features and characteristics of the building while extending the remaining life and minimizing any damaging treatment and ensuring appropriate additions to the building. And the historic tax credit can be claimed once the building is placed in service. Now, there are certain restrictions on the tax credit over a 5-year period. It's basically a 5-year compliance period for the historic tax credits. And some of those restrictions are that an owner must not sell the building for 5 full years after completing the rehabilitation, or if they do sell, the credit must be paid back. And also, the National Park Service can revoke certification if the work that was done was actually not what was described in the Part 2 of the application, or if the owner has gone back and made inappropriate alterations to the building, then the certificate of rehabilitation will be taken away, and then therefore the historic tax credits will no longer be valid. So if an owner disposes or sells of a building or alters the building within the first year after it is placed in service, 100% of the tax credit will be recaptured. If one of those 3 recapture events happens between year 1 and 2, 80% of the credit is recaptured. The tax credit amount is reduced by 20% each year. So as you can see, between 2 and 3, 60% of the tax credit is recaptured. And the National Park Service or the State Historic Preservation Office may inspect a rehabilitated property at any time during this 5-year period. So it's obviously very important to stay in compliance, or otherwise you may run the risk of recapturing the tax credit. So a bit more about when you can actually claim and when you can use the historic tax credit. Both the 10% and 20% of the tax credit is claimed on IRS Form 3468. And that is usually done in the year, the tax year the building was placed in service. And the question before on carrying a tax credit back and forward, you can carry it back 1 year, the year prior, or you can carry it forward up to 20 years. And for the 20% tax credit, the IRS requires that your Part 3 be filed with the tax return claiming the tax credit. And if the National Park Service denies certification of a project, the credit will be disallowed. On the 10% tax credit, remember that it is for non-certified historic buildings, so there is not the formal review, the Part 1, Part 2, Part 3 for the 10% tax credit. Now, there are situations where the owner of a building that does qualify for historic tax credits may not have a need or a want for using the tax credit. This can occur when the owner does not have a tax liability and of course then there's no need for a tax credit. And additionally, as with many times with projects, there's a shortfall in financing the cost of a project, and an owner will want to use the value of the tax credit to help pay for the rehabilitation costs of the project rather than use the tax credit. And when this is the case, there is a mechanism of what's called syndicating the historic tax credit in exchange for funds to finance the rehabilitation of the building. Now, syndication is a fairly complex project that can be a whole other webinar, but I'd like to make you aware of it. Basically, it's the process in which the owner of the historic tax credit or the owner of the building sells the credit to a buyer for the funds to rehabilitate. And the decision on whether to keep or syndicate the credit comes down to whether it makes economic sense. And there's a good step-by-step guide from my former employer, National Trust Community Investment Corporation. They're a subsidiary of the National Trust for Historic Preservation. And on their website, ntcicfunds.com, is a guide which takes you through questions and answers on whether it would be advantageous to keep the credit or to try to syndicate. In a nutshell, this is a simplified structure for syndicating the historic tax credit. The owner of the building would form a partnership with an investor so that both entities have an ownership in the building. And remember that only building owners are eligible to have the historic tax credit. The original owner becomes the partner with the majority ownership share and exchanges $1 tax credit for the rehabilitation funds from the investor, who is the limited owner. And as with any investment, there are risks perceived by the investor, and in this instance, the investor is risking recapture of the historic tax credits, so the price that the investor is willing to sell the funds to the owners is lower than a $1 tax credit. So depending on how much the owner, how many tax credits are available that the owner is selling, or what is the risk of the project being recaptured, the price can range from 90 cents to 95 cents, perhaps even higher for $1 in credit. Basically, an investor would run a risk analysis and then come up with a price that they're willing to buy the tax credits for. So obviously there's a point where syndicating would not make economic sense because the pricing involved is lower than the tax credit value. And a lot of times this amount is around $200,000. And it works best at $200,000 for the owner to use the tax credit themselves to reduce his or her federal income taxes rather than syndicate. And for larger amounts, it may be worthwhile to consider syndication. And actually, there are some limits on the amount of the tax credit you can use, and that is actually addressed in with the IRS and on the actual tax credit legislation. I didn't really get into that because that is a whole other webinar onto itself, but the National Park Service has a link on their website. It's called the IRS Connection, and that is a great question and answer for people who have questions about how much can they use per year in terms of the tax that they owe. So I would suggest checking out the IRS connection to find out more about that. So we have about 5 more minutes before 1 o'clock, and I would like to open it up again for anyone who had additional questions that I covered in the second half of this webinar. If you could please either raise your hand or write in your questions, that would be great. And while people are writing in questions or raising their hand, I just wanted to thank everybody for coming, and also to check out our website for upcoming webinars. As I mentioned at the beginning, this is our first webinar, so I hope you felt it was useful, and thank you for helping us be a part of our first webinar. So let me go back and see if there's more questions. Amy Augustine, I'm going to unmute you, and you had a question? Amy? Okay. I don't hear you, so if you could type in your questions, that would be great. Okay, one question that we did have was how is a contributing building defined? And that's a very good question. A contributing building, meaning a building that is contributing to a historic district, is defined as being a building that is characteristic of the district, basically helps define the district, and many times would be characterized as an individually historic building if it was not involved in the district, although it does not always need to be individually eligible. But it's basically helps define the district's features. Okay. Amy's question was, how long does it take for parts 1 through 3 to be completed? Well, a lot of times, obviously, that depends on the owner and initially the State Historic Preservation Office. If they have a lot of comments, it's obviously advantageous for you to consider those comments and incorporate them in your application. But basically, once the SHPO is in a position to forward your application, whether it's part 1, 2, or to get the final third one, the National Park Service has 60 days to respond to that application. So let's say if you were submitting part 2 and the SHPO forwarded it to the Park Service, then the Park Service would have 60 days to respond. So with that, it's right on 1 o'clock, so I will let you all get back to your workday. But thank you again for joining me on our very first webinar. And I also want to remind you to not forget about the upcoming California Preservation Conference, Preservation on the Edge. It will take place in Santa Monica, and it is from May 15th to the 18th. So I hope to see you there, and I hope to see you at an upcoming webinar. So thank you very much. Goodbye.